right, we are on. This is Jeff Mackey Live. I'm Spencer Israel. That is Jeff Mackey from the Mackey
Ooh,
Portfolio. Jeff, how we doing? It's been a couple weeks.
yeah, we're doing okay. I'm kind
Yeah.
of ish day in the market, but that's other than that, we're good. We're
All
good,
right.
baby.
Well, it was a super busy time for you. We had the holidays and the new year, and then this big retail conference, and the year started off with every retail stock was ripping. The past couple weeks have been a little quieter for you, right? On just like the news front. But
The
now we're coming
quieter
into
to a little
earnings
bit of a
again.
boot stomping. Yeah, I mean, it's we're expecting a pullback. Got a little lighter in the portfolio, and that's good. We got some cash. I'm going to put it to work. So
Yeah.
nothing to panic about. This is kind of a late January thing. Last year, as you recall, we kind of they started announcing tariffs right around this time. And man, that was a bloodletting. Turned out to be a pretty good year, but the hard way. That was a air pocket risk type of moment right up into Liberation Day. This is not unexpected. We already reported Christmas. It's a long ways away. Not even I start planning for Christmas in late January. So, it's a little pause that refreshes is what we're going through.
All right. Well, luckily for you, we're now fully into the earnings season, coming into the retail portion here very shortly. But we do have some earnings that are on your radar. I want to talk about the Starbucks report we got this morning. Starbucks, are they back, Jeff? Is that what's happening?
Back-ish. They're kind of back. It was a good report, and I'll be honest. I've been long Starbucks in the past. I would have loved to have been long the move from 85 to 100, and I would have sold today's earnings report kind of just along with the market itself. Failed the big round number. You and I both are kind of fans of the idea that 100 holds almost a psychic power for stock,
Yeah.
and it's boy did they get shot down. I think what you're seeing here, they had good comps for the first time in 2 years. That's terrific. There are things to like about the earnings, but you're seeing that they're running straight into margins pressure. And that's really going to be the highlight of the show today is I just wanted to compare these guys with another juggernaut reporting next week. But, great news. It was a good vibe quarter. 3% comps. That's great. It was driven by transactions, which speaks well for sort of the consumer in general. No one goes out and buys a $10 cup of coffee because they're that worried about the economy. So we still have that problem between consumer confidence and how people behave. But at the same time, they issued guidance that just illustrated how ridiculously expensive this super low growth coffee company is, even with the turnaround. And what Nichols found, the Brian Nichols, who's a highly respected, really talented CEO, they're doing much better than Chipotle at this point, but they're still faced with the fact that labor costs are going up, tariff costs are going up. And there's just not really that many ways around it. If you're Starbucks, you ultimately need baristas, and the baristas are kind of, frankly, overpaid for what they do, and a little bit of a union type of pain in the butt for them to deal with at a corporate level. So hard to cut expenses, hard to drive margins. Starbucks isn't collapsing, which was totally on the table 2 years ago. Nichols done what he was paid to do, which is save the company operationally. But even with those positive comps, that was a number to sell because that guy, this is not a 40 times a PE. This is not the kind of company that you're going to go pay 40 times earnings for, not with growth that's going to be capped at 3% revenue and almost negative growth. The guidance they issued today gets them back to like about half of what they earned 2 years ago as they rebuild. So I'm not sure what peak earnings looks like, but it's not going to be much.
You're saying it's not a 40 PE, but it is a 40 PE.
It's not with my money. It's not a 40 PE. I guess with the
okay.
market, I'm not sure what premium folks are actually willing to pay out there, but it does matter what you pay for companies, and you ultimately would back in the old days when I got started, which was shortly before electricity. You would pay kind of the growth rate times whatever, that's how you came up with your multiple companies growing at 25%. You'd pay 25 times earnings for it. We are out of that day and age, but at the same time, if you're not growing at all, I don't think I want to pay 40 times earnings just because I like your vibes and because, it's a nicer place to get coffee than it was 2 years ago.
All right. Well, fine. Then I'll take your lukewarm positivity here. On the stock, and I mean the chart speaks for itself. And what you said, they're not dying, right? They are Starbucks. Nickel has been in charge now for what, a year and
year and a
4 months.
half, give or take. Yeah,
Yeah.
and he's done, he got him sort of back on track, but there's only so much he can do. The company that we're about to talk about starts with A, ends with Mazan. They actually have just so many more levers they can pull, and they're reporting next week, and actually it's just there's a lot more reason to be excited. What Nickel can do at Starbucks is just limited. Amazon's been in the paper an awful lot over the last couple of weeks, right?
Yeah, we should talk about that. So this was the headline that I saw from yesterday, right? That they're cutting down, they're shutting down their automated stores where you don't have to check out. You can just walk in and walk out, right?
Yeah, yeah. An experiment that just had failure written all over it, and Amazon rather atypically kind of hung with it. Normally, these are guys who cut bait pretty fast, as you can see with the way they treated the employees that they wanted to get rid of. They don't stick around with bad ideas for very long. So they've been trying to get into physical retail for about 10 years. No real sense of urgency with it, which is atypical for them. They own Whole Foods, didn't do a lot with it for a lot of years, had these ridiculous kind of convenience stores, had different grocery ideas, all of which was really very half-ass. And so they're getting rid of them. Now, this looks like bad news, right? You got layoffs, you're closing stores. Under normal circumstances, that would be bad news. Under the conditions that Amazon's doing it, it's actually, I think, a sign of incredible health and just another more evidence that this company can move with much more speed, alacrity, and wisdom than the Starbucks of the world. They got a lot more options.
Well, it's not just layoffs today. Amazon, didn't they announce layoffs a few months ago? I think they did.
They did, and they said we're going to lay off some more people too. I can't imagine that was a super fun Christmas for the folks that were just waiting for the sort of Damocles to rip their heads off shortly after the new year started. But that's the way it goes. So they got rid of course, everybody that was involved with the other stores, but they cut about 10% of their workforce, which is just puts them in sharp relief with the Targets of the world, who you think they hold like 5 different meetings for everyone they decide to lay off. They've got way too many employees, but they can't make any moves. Amazon, when they decide to do something, they do it, man. It's a cutthroat, hardcore place to work. You don't see a lot of that kind of speed and efficiency from companies as old as they are. Amazon's not young as springtime anymore, but man, they move fast. And what we've talked about it last week, I wrote about it last week, actually, for subscribers, for the paid people, we really put our brain power to work. But Amazon, they are expanding their physical retail presence. Despite closing the garbage stores, they're opening their first big discount box, which is this 225,000 square foot monster store. For perspective, you could fit 2 Targets into it. You could fit kind of the better part of a Walmart superstore and a little bit of the parking lot. Big stores is what we're talking about. Big stores. What's interesting about them, though, is that they're going to be the first stores that are hybrid from the ground up, built for an on and offline world, meaning they're going to be distribution centers for the local community. They're going to be set for drive and pickup. They're just going to be kind of a new spin on a really somewhat tired model that Walmart and Target have been sort of riding for a long time, which is that just big box, everything's under one roof type of thing. These Amazon stores are going to be set up much more efficiently. I think it's going to drive margins much higher, and it's a big deal for them. It's because even though physical retail is a small part of the profits, it's a huge lever point for them. If you're doing $500 billion in retail every year, you get those margins up by a couple percent over what they are traditionally. And all of a sudden it gets much bigger, and it can change the complexion of what Amazon looks like from a capital structure.
Right. Because Amazon, as we all know, was an e-commerce business and is frankly is now it's way more diversified. Right. So,
well, it's AWS right now. And so it's going to, what they report next week, that's going to be the big story, right? Amazon's going to move based on how fast AWS is growing. The problem is that's really an expensive way to grow. And so they're paying more for CapEx and they're getting out of revenue growth. That's not terrific. You don't want to see that in companies. And I think that's why you're seeing a lot of these expense savings. But that's also why if they can expand this store footprint, they like that idea, not just because they're sick of Walmart kind of peeing in their sandbox with going online. 20% of business from Walmart is actually online right now. That's a big chunk out of Amazon's kind of house. And so, they're fighting back, but also because that's a cheap way for them to add revenues. That fixes the equation where they're spending so much in CapEx for AWS to support that growth. and really have been underinvesting on the physical retail opportunity, given the size there. And so physical retail offers a relatively cheap growth and expanding margins. And that's a super good story. That's exactly the opposite of the Starbucks story we were talking about before, where they don't have a lot of ways to get rid of baristas without making the lines longer again. And so their margins are going down and forever, and you're talking about a company that Amazon's actually 30 times earnings. Starbucks is 40. So Starbucks is more expensive on paper, and Amazon is just much better with a lot more opportunity in front of it. It changes the equation entirely.
So you have companies like Walmart encroaching on Amazon's turf. Now Amazon saying, "Back at you, Walmart. We're getting into physical stores. We're coming after you."
Which sounds like a one-off announcement, but they're building a huge store again, right? And it's just in the heart of it. It's outside of Chicago, sort of the main drag of Main Street America in terms of the size of the market out there and the affluence of the customer base. They're right between a Costco and a Walmart, down the street from a Target. This is not a low-key experiment. Those Amazon Fresh stores, you couldn't really find them. The Amazon Go stores were just this mishmash of locations. Not this time, baby. These are going to be huge stores. They're going to have grocery. They're going to have kind of clothing. They're going to have discretionary. It's a platform for them to sell Alexa speakers, everything that you can imagine. They've been talking about it for a while, but this is not just a low-key prototype that they're rolling out. This is a pretty expensive box. But the thing is that it will scale really, really fast. This isn't the kind of thing they're going to have to spend $1 zillion for on a relative basis. Building a data center costs an awful lot more than putting up 4 walls in a big lot outside of Chicago.
Well, that's true, right? I guess only because the cost of data centers have gone through the roof, and this is really, like you said, just 4 walls and a ceiling, and then all the goods inside. So, yeah.
And they've been driving, Amazon and Walmart, they have so much more kind of cash available for them relative to the Targets of the world. They've been going to automation really fast, and they've been going to AI really fast. In a lot of cases, you order something from Amazon, it doesn't get in anyone's physical hands until the guy gets out of his Amazon truck and throws it on your doorstep. Like before that, like nobody touches it. It's just like these droid bot roaming around in the back. It saves a ton of money. That's why they're able to do those layoffs. It's a tough world out there, but man, the margins on that change a lot. And again, we're talking about huge. If you talk physical stores, physical retail stores, big box only, you're about $1 trillion a year of the American economy is getting run through big box stores. Amazon's share of that is bupkis right now. I think they can do better than bupkis. So you roll these out, and we mentioned 20% of Walmart sales come from online. Amazon's able to pull off a trick like that. Well, they're about a $600 billion a year enterprise in terms of what they're doing. This could be a $100 billion business for them relatively fast. That's the size of Target, and it would add meaningfully to earnings on a kind of a leverable scale. It's doesn't have to be the lowest margin possible good thing. So they're going to make more money off a big store base. It's a huge opportunity for them.
Yeah, Amazon's interesting because like the stock has really gone nowhere. If you just look at the past few years, Amazon has not outperformed the S&P since like early 2024. It's been 2 years, really, right? It's really outperformed in any meaningful way. So.
Right, and they can kind of earn whatever they want. And again, they've grown into it. They coil up. This is how kind of growth companies work for a while. They go on a screamer. Nvidia's been underperforming for the last 18 months. Does that make them a lousy company? Come on, are you kidding? It's just they have to grow into the earnings base. But it's pretty rare that you're going to be able to buy a company as good as Amazon for even 30 times earnings. That's cheaper than Walmart. It's much cheaper than Starbucks. If you look at these two stocks over the last year, if Starbucks got off life support, congratulations, that's awesome. Amazon's investing billions to eventually make what will amount to trillions of dollars off about 10 different things, including physical retail. It's a big if, but these are really smart people. They're going to make physical stores that are going to be pretty good, and they're going to be able to roll them out fast once they get the model right. I would not bet against them. And I've been really critical in the past, saying that Amazon actually, ironically, sort of sucks at retail. I think it's time for them to refresh the entire discount model, and I think they're going to make a lot of money doing it.
I know you said they haven't done much in terms of the Whole Foods thing, but I swear every time I go to Whole Foods, there's like one extra thing of automation, and I get all freaked out, and I'm super intimidated because I don't know how anything works, and because I pretty much only go there to like return something, and it's a lot. So
They've slowly morphed, and I
yeah,
remember that was 2017. I think it was they announced that buyout, biggest acquisition that Amazon's ever done, I think, to date, and it just crushed the grocery industry. I mean, they ripped billions and billions of dollars of market cap out of every single grocer. And it turns out that Amazon, they've really just kind of been very slow about changing that. But in the meantime, they took it from sort of this organic kind of sticks and nuts grocer into, as you say, kind of a surprisingly high tech, multi brand type of operation. They've done a decent job with it. Nothing great. They're turning some of the stores they're closing into more Whole Foods. They say they're going to add 100 more Whole Foods. But as it wasn't ever intended to be something that would take on Walmart or Target or hit them where they live. That's been the opportunity for Amazon for a long time, and they're finally making a meaningful gesture in that direction. Now, it's going to be the kind of thing that it'll seem slow at first. It's going to take them a while to build its first store. They're going to get it right, but it'll seem slow, and then they're going to show up on a conference call sometime in the next 5 quarters, and they're going to say, you know what, we got this model right, and we're going to put 200 of these things up in the next 12 months. And at that point, it'll be too late to buy the stock.
This is going to be AWS data center 2.0, but for retail.
And again, much cheaper to make this than it is to make the data centers. And in terms of the leverage on the amount of revenues that it's going to generate, it's huge. It's a big deal.
All right, before we go, there's questions from the chat. Do you have any thoughts on the Lands' End WHP deal that was announced the other day? Where it's
amazing. Lands, congratulations to Lands' End. It's your Shetland sweaters are back in style. Not a ton of them. I'm not chasing it. It was just like one of those. Wow, that's. They followed a much more traditional trajectory of specialty stores, which is they come out, they're hot for a few years, and then you just kind of forget about them and disappear. And it's like, hey, look at that. Lands' End still exists. So it'll be a long road back.
Yesterday was its best day in a very, very long time. Let's put it that way.
Basically your lifetime, not mine. Your lifetime and half of mine. It's been a while. It's been a minute or two since we've seen that kind of price action out of Lands' End. I don't think you need to chase it necessarily.
All right. Jeff wrote about the Amazon physical retail Death Star phenomenon a lot more for his members. I think it's about a few weeks ago now. If you haven't read it, it's a really great rundown of the whole situation. The link is in the description on YouTube, and that is for members of the Mackie portfolio. If you just want to get Jeff's thoughts and his musings on retail, you should get the Mackie letter. The link to sign up for that is also in the description below on YouTube. And we'll be back as we are every Wednesday next week to talk about whatever is on Jeff's mind. So, Jeff, thank you as always, and we'll see you.
Happy hunting, my man. We'll see you next week.